Tony, Happy New Year and welcome to Money Matters. How are you feeling today?
Oh, happy New Year. I'm feeling amazing. I'm super excited to get this one going. It's January. It's like half the month's over, but I'm like, oh, all right, tax season is looming upon us, but we're ready to share all the tax tips we can today.
I know, right? And that's why on Madison's end, we were like, this is perfect. Because what do we need to start off the year, right? Proper strategies on tax planning. So, with that, Tony, let's kick it off. I have a very, very important question to begin our session today. It is, why do you think having a proper tax plan is important for everybody, not just self-directed IRA investors, but in general, everybody?
Yeah, so the big thing is I always tell folks like, would you build a house without a blueprint? Would you work out without a workout plan? Like, why would you file taxes without a tax plan? So a tax plan is really like a GPS for your taxes on how to save is like, you know where you want to go. Like, say if I want to go to Chick-fil-A or something, I'll just type in the GPS, go find it. It'll tell me exactly step by step how to get there. So the same parts for the taxes is that you have money and you can save money if you know how to play the game, but you need a tax plan to do this. And then the other part too is this is like a one-time thing that generally speaking, unless you like change careers, is that it lasts forever, right? It's just like a one time, hey, make out the full plan, you're ready to rock and roll. So it's just you can literally make more money by doing nothing besides doing tax plans. So if you have $100,000 and you're paying $25,000, $30,000 in taxes each year, Social Security, Medicare, income taxes, state income taxes, then what if you could save an extra $10,000 of that? So you make the same $100,000, but you save 10,000 of it, then you're going to be off to the races. Like there's a thing, the stat that goes, if you save $10,000 and you reinvest that for 30 years, you'll be a millionaire at 8% growth. So S&P 500, whatever ETF, simple, easy, Uncle Warren Buffett says, $300,000 of that will be your savings from taxes. So it's your own money anyways. And then $1 million being compound interest. So you have 1.3 million in 30 years. So that's why tax planning is just so big. It can like fundamentally actually change your life because you have so much more money. And then even if you don't reinvest it, say you have 10,000 bucks, you want to go take a vacation or buy a car, like you can just go do more fun stuff. Like if I gave you $10,000 tomorrow, Donna, what would you do with it?
I'm investing, Tony. Come on. We're in the
Yeah.
alternative space here. We're investing, and then I'm using my returns to go on that vacation.
There you go. See, there you go. It's like, what's that? If the genie grants you three wishes, one of the wishes have to get more wishes.
This
Yeah.
is why you and we are aligned because
Yeah.
I love what you said, right? You at least save $10,000 that, and you get to invest and compound that into something else. And I think people forget the importance of why would you want to just pay the taxes when you actually have IRS approved methods of saving those taxes? And that's where the CPA dude, you, the man, the myth, the legend comes in. So I love it. As a CPA yourself, Tony, what are some of the common myths that you see people think about CPAs?
Yeah, so common myths, I would say that, we're the most fun characters in the world, JK. Like, yeah, there's a whole bunch of different CPAs in the world. But, all jokes aside, the big thing about CPAs is that we are not the best communicators. And, by default, we just love doing the same thing, very sturdy, same thing every single year, file taxes. But the reason why I say we're not the best communicators is because most people think that when you go to a CPA, they're gonna save you all the money in taxes possible. However, generally speaking, all they're doing is just filing the tax return, keeping you compliant and out of jail, which is totally fine. That's how most CPAs, accountants, tax people are trained is to file tax returns. They're not actually trained on how to do tax strategy. Like even for myself, I took the CPA test, 9 months of my life, I had 12 hours a day studying. I worked at KPMG, one of the biggest large four companies there are. And then I worked at Uber, DoorDash, tax departments. They didn't teach you any of this stuff. So I had to go out and learn it by myself. So like YouTube University, watch every YouTube video possible. Shout out Mark Kohler, he's the OG. And then also all the books like Tom Wheelwright, Tax Free Wealth.
Hmm.
But even those, they don't teach you how to save. They give you the theory. There's no step by step. And I was like, man, this is a really gate kept part of the world. And they make all these technical terms, I believe, like my own conspiracy theories, like they make it so much more confusing. So it's confusing to the general public, so you don't have access to it. So the rich get richer. But everyone can be rich today. So like the thing when you go to a CPA, they're just filing your taxes, and that's totally fine. They're just like, hey, I'm here. Can you file my taxes? Cool. But your expectation is that they're gonna save you all the money, but we don't communicate that to you. Like the clock struck, December 31st, midnight, Cinderella turned back into the pumpkin. It's pretty much game over besides like, a handful of things. So like that's the biggest like misconception about when you're using a CPA or a tax pro H&R Block TurboTax that it'll save you money. It will not save you money. Tax strategy is a whole different service compared to tax filing and compliance. Actually, was on another webinar, and we're talking about this guy was outlining the professionals that you need in your life, and he actually said that a tax strategy, like tax strategist, is one person. Like a person that files taxes is a tax filer is another person. Generally speaking, they're two different people. And even like for myself, like I can actually do both, but I'm a weirdo. Like I'm a unicorn. But that's like our whole company is now divided into tax compliance, people file taxes, and we have tax strategists on our team because the way that they think is so different. So like generally speaking, it's like two different people you need to engage for. So you need to look out for a tax strategist if you want to save money on taxes. If you want to stay
Hmm.
compliant, then you need a tax filer.
I love you said that because I work with a lot of high net worth individuals, right? And I think
Hmm.
they always have that misconception. They think, oh, my CPA is going to save me a lot on taxes. I'm like, but did you actually sit down with your CPA and review what are the strategies they are using for you to reduce your tax liabilities? Or do they just file it and let you know, hey, you have to pay this much to the IRS? And it's very rare you find CPAs that are also, like you said, like a weird combo mix of tax strategist and a CPA. That's really why we wanted to bring you on our platform, right? To speak about that. Since we are there right now, I want to let our audience know, guys, please use the chat feature, put in your questions. We will definitely be looking at that question. And Tony here is going to be our in-house CPA today to help you with your questions. But till that comes, let's actually talk a little bit about these tax strategies because I think that's the most important part, Tony. With your experience, walk us through some of the tax strategies like self-directed IRA investors must know about.
Oh yeah, so many tax strategies to use. The big part too is actually you're sitting on cash. Like how I said it. We started with if we can take the existing salary that you make today and save you more money, you don't have to change anything. You're gonna have more money. Now, saving money is one thing, making money is a whole nother thing. So you can actually use your taxes to make more money. And literally one of the biggest things that's being slept on is self-directed IRAs, right? So the big part is, usually, well, I think they said the average stat, don't you really change seven jobs, seven careers or seven jobs in your lifetime now? So more likely than not, you've probably changed jobs at least once. You maybe
Mm-hmm.
start a small 401k back in the day, but it's compounded and it's just sitting there. So I'll talk to many of our clients. I'll have like three, four different 401ks, IRAs just sitting around. The big thing is consolidate them all and start investing. So the best one of the tax strategies is like deferral of taxes, right? If you defer and kick the can down the road, it's going to compound into something bigger. So, like using a self-directed IRA, for example, take all your old accounts. So, if you've changed jobs and you haven't consolidated it all, take it all, consolidate into one, then you can do so much with it. Private money lending was huge in the last 2 years just because people didn't want to buy as much. But other people wanted to buy, but they didn't have access to capital just because there's that whole trend right now is like other people's money. So
Mm-hmm.
you can become the lender yourself. So you have 10,000 bucks, you can easily charge 10%. Many of our clients are charging 20, 25% like interest on on actual loans. So private money lending, the cool part though is that if it's in that like so like the bucket of
Mm-hmm.
self-directed IRAs, then you don't pay any income tax. So if you have $10,000, 10% interest, that whole $1,000 of interest is all tax-free. Otherwise, they get murdered at your ordinary income tax bracket between federal and state. So really strategizing, make more money. Use your money to make more money because time's money, right? So just let that brew. Outside of private money lending, flips are becoming big, right? Lower entry to get into, and then it's a great way to get a lot of money tax-free. Otherwise, you're going to get killed on, potential capital gains taxes, depending on how long, generally ordinary. So that's going to be a big one from a self-directed IRA standpoint. The other part too, yeah, if anyone in the chat wants to drop, whether they're a W-2, real estate investor, or business owner, that let us know, and then we can, take a look and gear some parts. But I'll just go one strategy for each, just because I don't know who's in here. So let's go our W-2 folks. So if you're listening to this over lunch right now and you're sitting in W-2, I'm like, oh man, can't wait till I can retire one day. Like, let's save you some more money. So what are a great way to save money as W-2? The big things that you can do, and it's always going to be in the charity space. Charities are always huge. And then this year, the new one big beautiful bill, they're actually allowing you to take a $1,000 above the line deduction for charitable contributions. Generally speaking, in the past, when people donated, they didn't really help because your itemized deductions weren't as high as your standard deductions. So charity is great. Even starting up your own private family foundation is huge. So we've all heard of the Bill and Melinda Gates Foundation. So you can have your own foundation and carry out the purpose that you want. So that's amazing. Leverage charitable donations are great. So tons that you can do there.
Question for you, Tony. I'm sorry, because I love
Oh
this.
yeah.
Now my mind's thinking too, right?
Yeah,
Because
yeah.
even for
Uh-huh.
me personally, these tax strategies are fantastic. So for the charitable contributions, you said now you get to deduct $1,000. I'm guessing there's documentation, right? What do we need to show for that deduction?
Yeah, yeah. So you just want to grab a receipt. The donation has to go to a qualified organization. Qualified organizations, generally speaking, are nonprofits, schools, churches. So you just need to get a receipt showcasing the date, the amount, and who from that organization. So if you donate, grab that receipt for you, and it's actually going to help you this year. Unlike most years, it didn't help you. So it's great to do that. $2,000 if you're married, actually. So it's going to be a great way to give back to those organizations that align with your values.
Amazing. And does that also work? I know you mentioned something about, and I've heard this a lot as I've been traveling, where especially high income earners are setting up their own foundations. How does that work? Walk me through that.
Oh yeah, so yeah, you got Bill and Melinda Gates, you got all the like athletes, professional athletes. So it's a private family foundation. So this is a nonprofit actually. So it's a nonprofit, and what can happen is that you can actually stow away 30% of your adjusted gross income into this. So if you make $500,000, you can donate $150,000. They'll be added as an itemized deduction for you. So then your taxable income is going to come down to $350,000. So you just shaved off 30% of your
Hmm.
income. Now, that's the pros. Now, in the tax code, I don't care who it is, there's always something bad. Like, what's the catch? Like, if I think it's
What's
actually
the
like,
catch?
yeah, like,
Exactly.
yeah, I think if it's too good to be true in life, I think it actually is. Like, there's besides you giving me a free lunch, there's no free lunches. Like there's actually no such thing as a free lunch unless you have really good friends. But where what can happen is that now the cons of it is that one, maintenance fees are very high. Maintenance
Hmm.
fees, you're gonna have to file a nonprofit tax return, do the bookkeeping, do the accounting. The accounting you can't do yourself because it's nonprofit accounting, it's very specialized. So that's gonna be around 10 grand a year. So we use a nonprofit partner ourselves even. So that's gonna be number one. Number two is that $150,000 I just talked about, it is now stuck in there. So you have to use that money to carry out the foundation's purposes. So generally speaking, that's why you hire mom and dad, brother, sister, family foundation. It's the family who works in it that you're supplying.
Mm.
So that's how you kind of like use the
That's
funds.
smart.
Yep, yep, uh-huh, that. And then number three, this is like, I'm not con, it's just right in the middle. It's just a rule. You just have to donate 5% of the asset value each year. So if you have, $100,000 left after all expenses, then you have to donate $5,000 to, the cause. So generally, that's why you start up scholarships, right? So if I want to start up a tax literacy foundation, then I want to sponsor the kids at Berkeley. I'm just hand out a $5,000 scholarship and then give back to the community that way. So a great mechanism, great tool is a little bit more advanced. Like you probably want to be a few $100,000 to make those maintenance fees worth it. But it's a great strategy to start putting in place. Or if you have a just a big cause that's very near and dear to your heart, that's a great thing to do.
Absolutely. Now, let me ask you questions. I'm sure people in our audience right now thinking the same things, right? All right, Tony, I make $500,000. I'm putting $150,000 into this trust. How do I access it? Right? What are the rules of this? And of course, when it comes to the scholarships and found charity, right? Is that another write-off?
Oh yeah. So you put 150 grand in, and then so you personally, there's no self-dealing. So this is like you legit giving $150,000 away.
Okay.
But at least it's like in your foundation that you own.
Mm-hmm.
So then the other cool thing though is you can go raise and like get donations for your own foundation. So it's not only you putting in, but say if you want to go just kind of a hey, and the year donations, hey, if you align with financial literacy, tax literacy, and you want to donate it and get a charitable contribution, that's cool too. So in terms of like you can't self deal with it, that's why you have to really carry
Mhm.
out the missions. Also, like if you have a mom and dad that's retired or broke brother, sister, you hire them to carry out the foundation. So if they're going to go do events and teach about financial literacy. I'm just using this one as an example, just because I'm a very big finance guy. So like if we want to go teach the local community, like, hey, the kids that the stuff we wish we would learn in school of like if someone actually
Exactly.
taught us like finances and
Taxes,
taxes would be
right?
exactly. So we just be like, hey, that event was $3,000. We gave out 25 books also, and we had food and everything. That's a great way to use the funds.
Amazing. Perfect. So what else? What other, especially since we started with like W2, I can see some of the questions coming in too. So I will
Yeah.
definitely throw some of the audience questions at you in a few minutes. But what are the other tax strategies have you seen, especially with the big beautiful bill that came out last year, that our clients, our audiences can use? And don't forget, a lot of our audiences are a lot of our audience are self-directed IRA investors, right? So
Yeah.
what can they really use for tax strategies to grow their retirement, but also retire faster?
Oh, yeah, definitely. In that case, I would definitely go real estate, right? So real estate is probably gonna be your biggest. So use a mix. So use your self-directed IRA for funds, then also use some personal cash as the funds too. And the big part is a short-term rental loophole. So this is the Airbnb where you rent out an Airbnb and you have three prongs. Have an average stay of 7 days or less. So you have small, short stays. So you just have a total days divided by total stays. As long as that number is 7.0 or less, you meet prong number one. Prong number two now is that you have to show material participation. So that means you
Hmm.
actually worked within the property. So you have 100 hours or more, no one else works more than you. Now, why do we do all this? So whether you're W-2 or you have a ton of money from investing or you're a stock trader, like anyone, all those losses are going to become unlocked for you and can reduce all your other active income by using a cost segregation study. So cost segregation study there, what that is, it's not a foreign term. All it is a study that breaks down the property into smaller components. So you're able to deduct and use bonus depreciation. So that's out of the one big beautiful bill. Bonus depreciation is now 100% again. So if I've tied all back in, so let's just say we buy $1 million Airbnb, any house in California is $1 million. And we say we put, 10% down, right? It's gonna be a second home that you'll eventually use for vacation. So we're $100,000 out of pocket. Now we're gonna use the Airbnb loophole, and now you're gonna actively manage it. You're actually gonna, have quick stays in and out, and then you get a cost segregation study. Got a great company if you need one. And then so you get 200, $300,000 of depreciation the first year. So now we created let's just call it 250, a $250,000 deduction, yet we only paid $100,000 out of our own pocket. We've arbitraged 100, we've made up a real deduction out of thin air. It's like, boom, I got $150,000 here because we're using the tax code the right way. And this is how the rich don't pay taxes. So you got Robert Kiyosaki, you got Donald Trump, you got Grant Cardone. Why are all these guys talking about real estate? You buy real estate to retire faster. You use real estate to reduce your taxes. You use real estate to build wealth, right? So there's just so much you can do in the real estate world. And then there's so many excuses I always get. So I'll present these great ideas. They're like, cool story, bro. Like, where am I supposed to get money? And I'm like, well, let me ask you. I'm like, do you own a house today? Like, yeah. I'm like, all right, how much equity do you have in it? "Yeah, I got like 300,000. 300,000 home equity line of credit. Cool. You got money. Second part, what do you have in your retirement accounts? Oh, I got 750,000. I'm like, dude, you got plenty of money. Well, I can't use it. It's on my ETFs. It's in my target date retirement fund of 2055. I'm like, no, there's a tool called a self-directed IRA. It's just you
Correct.
don't know the rules yet. And it's not anyone's fault here. It's the system's fault. My conspiracy theory is that They don't teach you the stuff in school because they want you to keep on working W-2 because you pay your Social Security, Medicare taxes, the employer pays it. You keep on running the rat race. They got you for your whole life. You're not inching closer to freedom. So you have money, you just don't know it yet, which is fine. I just need to be here to tell you you have money, my friends.
Thank you for really saying that loud and proud because I think I've made it my life's mission to tell people retirement money, that's all you really need to start building wealth. And real estate is the number one, right? And we had another podcast where we discussed where real estate is the American dream. There is so many IRS approved strategies to not only help you build wealth through real estate, but also reduce your taxes. Now, question for you, because I get this question a lot from the Madison Trust side of things, right? With cost segregation, can the depreciation be applied to a self-directed IRA investment versus a non-self-directed IRA investment, Tony?
Yeah, so it can, but the only downfall is that for cost segregation, so what happens is that you're going to generate a fat loss. And of course you can take it. However, in a self-directed IRA, what happens is like the beauty of a self-directed IRA though is you don't pay taxes.
Correct.
So that's the beauty of it, but it's also a double-edged sword because if you generate losses, the losses aren't recognized. So that's the only downfall, but that's why I say, hey, can we do a mixed title? I have people investing into syndications where there'll be GP as GP and LP on the deals, or they'll come in as two different LPs, limited partners,
Mm-hmm.
general partners. Sometimes I get too tax nerdy. I forget the terms. General partner, for those who don't know, limited partner. General partners run the deal. Limited
Mm-hmm.
partners, you're just a passive investor. I've seen it where they'll invest part into self-directed IRA as a limited partner, then they'll take their own cash and invest as a limited partner again. So
Correct.
you can get both because if you're putting money in the deal, you know that deal is good, unless you're not putting money into it. But you want a bigger slice of the pie, and you can use your self-directed IRA for that.
I love that you differentiated that because I always tell, like you said, right? If it's too good to be true, it's too good to be true. With the self-directed IRA, you have those tax advantages. You defer or it's tax-free. But then again, you can't have your cake and eat it too. So something like cost segregation, book losses such as depreciation, that has to be something that you're owning personally versus a self-directed IRA. But I love the strategy that you said, right? You can be two different LPs in a deal, your personal money versus your self-directed IRA money, you're still creating wealth and you're getting those losses. Now, real quick, Tony, would you, I know I can see our questions are blowing up. Do you want to answer a few questions from our audience?
Oh, sure. Let's go through it. Yeah. Uh-huh. All right.
Okay,
Nice.
perfect. All righty. So first question, how to record self-directed IRA transactions in P&L or bookkeeping? Do you just exclude? And this audience member is also a hard money lender.
Oh, nice. Okay, cool. So how do you record it? Like what I would recommend for you is that generally speaking, and then if you're doing private money lending too, is that there's many ways to do this. How I would go about it, make it easier, is if I'm using QuickBooks, such as an example, there's a feature called classes. Classes are pretty much like different like service lines. So you would have your self-directed IRA in one. So you got property A, property B, property C, and your personal investments. Then what I would do is I would create a class specifically for a self-directed IRA. Now, because I'm going to treat my self-directed IRA as the custodian, as pretty much my own legal entity. Then from there, that's the top side. Now on the horizontal side, I would create a chart of account, and then I would do private money lending revenue. I would do rental revenue. I'd do late fee revenue. So all my different chart of accounts, I'd set that up, and that'd be the best way to track it.
That is amazing. Thank you so much, Tony. We have another one. Oh, I'm a young retiree. Congratulations. Been retired for
Nice.
3 years. I love that. I have over 1.3 million in TSP. What advice do you have for moving the money out and reinvesting in something else, but at a tax advantage? I would prefer to move some out and leave about half or more in the TSP.
Yeah. Yeah, so if you want to, there's definitely different types here that you can do. So it depends on really what you want to do. Like, well, yeah, congrats on retirement. Maybe actually I have a lot more time to do more in the real estate side because real estate does take a little time to manage. So you could definitely roll over part of this into, say, a self-directed IRA, or if you wanted to start doing some type of Roth conversions, you can take a little bit of Roth conversions over time. I have some clients doing that. But the biggest part too, so those are two options for you. The biggest part though is like I would want to like go more upstream and think about what's my strategy though. So my strategy, because then I would pick the proper tool to execute the strategy. So I would ask yourself, what do I want to do in retirement? What do I want to do with this money? Some people like I want to leave as much behind for my children and grandchildren. I want to live my best life. So it's going to be and use the money before I die, right? So that's going to be a couple ways. It's going to completely change your answer actually. And then also like, do you want to make what type of investments you want to make? So a few other things, but like ask your CPA, hey, what's our tax strategy for minimizing all of this money with my goals? So we always ask our clients like, what's your 12-month goal? What's your five-year goal? So we need to understand because your tax strategy needs to reflect what your goals are.
Perfect. Amazing. Thank you for that. And then we have another question. I have a rental property in a self-directed IRA. If I ever wanted to take the property out of the self-directed IRA, is there a strategic way to do it? Also, if the property is still in the IRA and I need to take a RMD, how would I do that if my rental income wasn't enough to generate the RMD cash? That's a fun one.
Oh, this is loaded. Yeah. So the first one to get it out, you would take a distribution. Distributions would be taxable. However, from a strategy standpoint, then, depending on if you can execute a deal, then I call it kind of like the lazy 1031 exchange. Not a technical term by all means. Yeah. Yeah, the tax code probably does not have lazy in the IRC code. But what you would do is you sell that property, get it out, to distribute it out, and then go buy another new property, take to use a cost segregation study, and then take bonus depreciation, and you would reduce your gain on that side. So that's probably the best way to get the money out of there.
Perfect. Now, I want to ask you just for that same question, right? For a strategic way, would you also recommend before, because real estate has appreciation, right?
Yeah.
Roth conversions,
Hmm.
converting at present time, expecting that appreciation down the road and then selling. What are your thoughts
Yeah.
there?
Yeah, so for properties to convert, or Roth conversions in general, I would say so. One is generally speaking, if you think that you're going to be a higher tax bracket down the road than you are today, doing a Roth conversion could be better for you. Two, if you have a big loss year, or if you also plan on like using some type of depreciation play, qualify for real estate professional status, a great time to convert also. So converting could be good for you there. Really depends. This is where you guys sit down with like your three mains. Like, if the money's in the self-directed IRA, definitely, here, Don the expert, us, the CPA, and then also your wealth advisor, because they generally should have a plan for your retirement plan. So it depends on like when you want to convert. And that's the
Hmm.
tough part because some people like, I do traditional, do it, I do normal. I'm like, I don't know, what are your goals? Like, what does your financial
What's
advisor
the
plan
goal,
on you?
right?
Yeah, yeah. I know it sounds like kind of like woo-woo-esque, but I'm like, and some people kind of get annoyed. I'm like I can tell you it's optimized for me, but I don't know what your goals are. Like,
I
that's
mean,
my main thing. Yeah,
all this, Tony, and you and I speak about this a lot. You have to figure out your end goal. You can't go about tax planning blindly. So
yeah,
that's really I know having worked with you that you're big on that. What's your end goal? And let us help you try to get to that end goal.
yeah.
Amazing. All right, we have another question. We have a lot of questions from our audience, so you're going to be busy for the rest of the time here.
All
Um,
right, there we go. Let's rock and roll. Yeah.
Is there anything special we need to consider when filing for our LLC annual reporting? So some of our clients have checkbook control, like IRA LLCs within their self-directed IRA. So do
Oh,
they have to do
nice.
anything special? For example, it asks total amount of business transacted last year.
Yeah, yeah. So for those type of LLC filings, this is definitely there's two parts. There's always a legal component and there's a tax component. So depending on what state you're in, there could be a tax reporting requirement. So sometimes states just like to know how much money you're doing. For example, Texas, they got their if you have an LLC, you have to file like the gross annual sales each year. If you're under, you can just like not. And then for example, California too, you still have to file a 568 tax return. So those are like and then New York has like a $25 minimum LLC fee. So those are a few states that have quirks in terms of like LLCs, single member LLCs. And then on the legal side, I'd definitely consult your attorney on that. But usually from a legal compliance side, there's always annual reporting requirements to keep your LLC up to date, and then it won't be out of compliance, and then it won't be suspended by your Secretary of State. So definitely there's maintenance with the LLCs that you have to do. Not rocket science. It's just tedious more than anything, but just contact a pro, and then that way they'll be able to guide you the right way.
Perfect. There is one question here about conversions, but we might need some guidance on this one. The question is, like to get information on IRA backdoor and mega backdoor IRA process. I'm getting different versions on how to get it completed. So, if that audience member could just elaborate that a little bit more, because I think they're asking about the Roth conversions, but the backdoor version, if your income level is much higher to do a Roth conversion. So I just want clarification on that before you answer that, Tony.
Oh
So
yeah.
moving on to the next one. I've been at the same company for 12 years with a 401k. Is there any way to invest it via a self-directed IRA without leaving the company? I love this one.
Oh, this one's I might have to tap into your expertise on this, Don, but like the one that I've seen is that if your plan, so it depends on the plan, and if they allow for in-plan rollovers or is distributions, those are generally speaking the ones I've seen. What have you seen your expertise?
So, what I've seen is it all depends on the plan document, and every
Hmm.
401k is different. Every employee retirement thing is different. Most of the time, you either have to leave the company to get access to their 401k, but in rare occasions, Tony, I have seen you can actually talk to the company and see what percentage of the 401k is eligible for distributions. And if that's the
Mm.
case, you're able to take a distribution out, and this is something an indirect rollover where you take a distribution out to yourself, right? And then you have 60 days to roll that into another qualified retirement plan, including a self-directed IRA. But very
Oh,
far and few I have seen that. So I always tell clients, if you're not sure, call your plan administrator and you
yeah.
ask them, how much of my 401k can I roll to another IRA? If you can't roll to another IRA, you ask them, do I have the option of an in-service withdrawal? So that means you're still employed at that company, but can you take a distribution out?
Oh, nice. Oh, I like that. Okay, so back to plan, but yeah, in-service distributions, that's really good there. Yeah, and then I think a
Exactly.
couple bonus items too is like if you're digging into the plan already, also check out if they have 72T
Yes.
elections. So for those on the crowd here for the 72T elections, is that if you're able, you can actually take money from your retirement account, but it has to be over at least 5 periodic distributions. So if I have $100,000, the IRS has that 72T election that says I can take $20,000 for the next 5 years, and they will not penalize me 10% if I'm under age 59 and a half. So all you have to do is pay the income taxes. So that's another like quirk you can do there. And then worst case scenario is that you can also do you can do the $50,000 loan from your
Loan.
401k to get it out. So there's many options, and that's just like tax planning. It's just a bunch of tools. You just have to know to pull it out at the right time. There was one wild one. It's just like
Okay, like
she
Siri.
lives she lives 4 houses down from me actually. So this is like my neighbor pretty much. And she found me on Yelp actually. And unfortunately, I think it was her mother or father passed, and she was a nurse. And then she's just like, nah, F this, I'm out. Like, no more of this nursing crap for me. Withdrew the whole retirement account, didn't tell me. Like they came to me after. They're like, what can we do? And I'm just like, excuse me? I'm like, you just drew 6 figures out of this. So then what we ended up doing though, we did two things was number one, bought a laundromat. The laundromat, we're able to bonus depreciate all the
Appreciate a
equipment.
lot.
Yeah, so the gain, the taxable income. So if you take, let's use $250,000 out, you're getting taxed on that plus a 10% penalty.
Correct.
So you're probably in California at 60%, right? 50% federal and state, and then 10% penalty. So first you got to reduce the ordinary income. Then afterwards, I see it every so often as I'm walking the neighborhood. They bought the RV. So they bought an RV. We use Section 179 and bonus depreciation to wipe away the whole RV cost. So they were able to take it up, but that's like the worst case. But they still had 10% penalty though. That was the issue. So
Yep.
Yeah, depends. There's many ways. That's just the least optimized way to get it out.
Yeah, it depends on what's the right way with the least tax consequences. I believe that other audience member did discuss this. So I think he's asking about what's the right way to do a backdoor Roth conversion versus a mega backdoor Roth conversion.
Oh, okay, okay. So we're talking about just wait, Roth conversions or maybe backdoor Roth IRAs?
Both. It looks like, so I'd like to get information on IRA backdoor and backdoor IRA process. He's getting different versions on how to do it.
Okay, I think I know your question. I'll probably just drop off on all I got for you here. So if you make too much money, aka I think it's roughly around $160,000 this year,
Correct.
for Roth IRAs, the money that the number goes up each year for inflation. But let's just pretend you're at the max cap. You cannot contribute to a Roth IRA directly. So they're like, you're too rich, you can't put money in. So what you can do instead is called a backdoor Roth IRA. Simply put, all it means is that you open up a traditional IRA, put the $7,000 in there, and then afterwards, there's a 7,500. Keeps on going up. I need to go refresh it. Yeah, yeah. Inflation, baby, it's coming. It is here.
2.7%.
Yeah. Uh-huh. Then you take that full amount and put it into, and you just call it the brokerage the next day. You can actually do this online. Just wait a day for it to settle and then
Hmm.
put it into a backdoor Roth IRA. So you're just moving money from your traditional into your backdoor Roth IRA. So that's the first chunk. Now, if you want to do the mega backdoor, so the mega backdoor last year was 70,000. I believe it's 72,000 this year. So
Hmm.
first you've accomplished the 7,000. Then if your employer has any type of like 401k matches, or if you have any type of like IRA matches to put in, like some people are on SEP IRAs, then you have to account for that portion. So let's just say
Hmm.
that's 3,000. Then you have 3,000 plus 7,000, you have 10,000. Now there's a remaining $62,000 that you can do a mega backdoor into. So now you have a crap load of money into your mega backdoor Roth IRA. All that money grows tax free. When you take it out, it's tax free. Now, that's the great part. The only downside of it is one, all your money is, that's a lot of money to put away. Two, you can't access it right away. And then you're not going to get a tax benefit today. So that's the only downfall. So I would always be mindful of like, does this align for like when you want your money? Because some people I've talked to, they're on that fire mission. They want to just
Hmm.
retire early. Some people are like, I'm just going to be here till I'm 59 and a half, 60. And then I'm like, I'll take my money then. So that's how there's many moving parts in order to get that the maximum amount.
Absolutely. And something I want to add there, right? Like with Madison Trust, we are a self-directed IRA. To do the Roth conversions, even the backdoor Roth conversions, we have a form. The clients can fill that out. Once we get it for the traditional account, we process the Roth conversion into the Roth account. However, if the money is coming from another retirement plan, like a 401k or employee-based retirement plan, that's a direct Roth conversion. You're able to transfer pre-tax money, traditional money from your 401k directly into a Roth IRA. The 401k plan admin gives you a 1099. We give you a 5498, which helps you with your taxation to show, oh, a Roth conversion did happen. A huge misconception with a lot of people because the process isn't clear. So thank you for
Mm.
answering that, Tony. We are nearing time, but we're gonna do answer a few more questions because
Oh
it's
yeah,
it's
sounds
it's
good.
very heated in the Q&A session right now.
There we go.
Okay.
That's good.
Okay. Um, this is a good question. How is a self-directed short-term rental best handled as an inheritance for our children?
Oh, so how's a short-term rental self-directed best
Yes,
handle
a
for the children?
self-directed short-term rental handled as inheritance for the children.
Oh yeah, and it's in an IRA, in a self-directed IRA?
Yes.
Oh, uh-huh. Interesting. Yeah. So actually that's a really good question. Cause yeah, I don't think we've seen that portion, but just going from a theory perspective is like if the property is housed by a self-directed IRA, then then when you pass, oh, then you'll just have RMDs. Then yeah, yeah. So you have RMDs that you'll have to take. And then yeah, when unfortunately, yeah, I think that's the case. Yeah. So if you have the IRA has property, and then we pass, yeah, then it goes off to your children or your heirs
Mhm.
or grandkids. Yeah, then you have to take RMDs.
RMDs out, and I also,
Yep.
when it's getting passed down to the children had the beneficiaries, they have election options, right? And sometimes they do choose to take a full distribution out or elect to take an RMD out until they like like completely kill down the account. So if you have questions on how to, like, how does that beneficiary portion works, Madison Trust support team is well versed, and we are
Oh, nice.
CISSP experts. Give us a call and they can definitely walk you through some of the beneficiary election options they might have. And then, okay, like, see another question. Has a hard money lender, is it safe to lend money to a borrower buying a property in their self-directed IRA? Interesting question. What safeguards would I need to put in place? Would I still get first position on the property?
Oh yeah. So yeah, if you're private money lending from your self-directed IRA to someone else's self-directed IRA or in any vehicle on it, the general rule here is that definitely have your attorney put in the proper promissory notes and then also what positions you can take on it. So it's really up to the legal documents that you draft up with your attorney, stating the terms of like what happens if defaults happen. So I would say there's never like anything that needs to make money. There's always inherent risk with it. So there's never a safe investment at all. So I would say I would lean towards really getting a solid contract in place, especially if you're doing PML.
Oh, absolutely. With regard to private money lending and in general, anything doing with your self-directed IRA, we always say speak to financial professionals. Don't download something from Google or ChatGPT and just hit the ground running. Make sure that you are protected because at the end of the day, it is your retirement money. So thank you for that, Tony. And then another question. Do you have to file a tax return if you have income in your self-directed Roth IRA?
So I have to file income tax return, maybe an income in your, I believe there's still UBIT actually, right? Like, yeah, because
So
if you have, yeah, it depends on the income too.
correct.
Yeah.
It
Hmm.
really depends on the income. If it's passive income, it's a self-directed Roth IRA, you get those tax advantages like rental income, for instance. But if it's an active income, for I always like to use the pizza business. If your self-directed Roth IRA purchases a pizzeria and it's active business, then you have a chance of high chance of getting UBIT.
Yeah. Oh, okay. Cool. Cool. Yeah. Because I was like, oh, it's, yeah, because yeah, it depends on the type of investment. So passive, you're good. Active, you got unrelated business income tax.
Unrelated business income tax, because the whole
Yeah.
purpose with self-direct any IRAs in general, right, is to create passive income to retire comfortably. But if you go beyond that, and that's active businesses, and sometimes that's why I also clients ask me, Don, I'm flipping houses. I'm like, how many? And they're like 10 to 15 a month. I'm like, oh, speak to a tax professional right now, because that is that looks like your IRA has an active business inside it. So great
Oh, yeah.
question. And then this is going to be our final question. And then I want to give Tony some time to give us some last minute tips and tools to get ready for tax season. Final question is there anything else I can do to reduce my capital gains tax liability on the sale of my primary residence that had an attached short-term rental? I'm a real estate broker, an active participant. Besides Section 121 and the figuring on added cost basics, looks like I have about $450,000 exposed to capital gains. Ouch.
Oh, yeah. Uh-huh. Okay, got it. So if you use the Section 121, so the $250,000 if you're single, $500,000 if you're married, and then you still have an excess to $450,000, assuming you didn't sell yet, and part of it was for investment purposes, you can actually do a 1031 exchange and the Section 121 exclusion. So you could 1031 a portion and defer the taxes. Now, if you already sold it, then it's a whole another can of worms. The other
Hmm.
part now is that if it's already sold, you want to look into advanced capital loss harvesting, tax loss harvesting. So this is where you generate capital losses on purpose in the short, and in the long term, you trade back to have it. You make your money back. So we had one guy. He had a $3 million capital gain, and what we did was we deployed the long short strategy, where we generated $3 million of capital gains for him. So he's paying $0 on his sale of his business. And this was done by leveraging his existing stock portfolio. And then we have like an asset manager who does this specifically. So what happens is that they trade against the Russell 1000. What they do is they'll buy like Pepsi stock today, wait for it to drop $5, sell it on purpose to lose you $5. So yes, you have lost $5. But what happens is that they'll replace it with Coca-Cola stock. that they see and are betting that will come back $5 more. So in the long, you will not have any true true economic loss, but now you
Mhm.
realize a $5 capital loss that can offset all your capital gains. So that's probably like my go-to strategy for this person specifically.
Oh, I love that. I feel like, Tony, I know you're gonna about to get a really busy for tax season, but right after, we're gonna bring you on again because we need you to walk us through those strategies because that sounds absolutely fascinating. Now, before we wrap up, Tony, you've been amazing, and I know our audience has loved you answering all these questions. What are some final tips, advice, guidance you can tell us? It has the CPA dude and the tax strategist.
Yeah, for sure. The biggest thing I always say, the thing I'll probably die on for my mantra would just be, have a tax plan. And the tax plan doesn't have to be super crazy, but you need to have some plan. Like the Ben Franklin, if you fail to plan, you plan to fail. So have some plan in place. And the plan doesn't have to be anything crazy. It can be as easy as I'm going to open up a self-directed IRA. I'm going to put my 7 grand in there this year. Boom, there you go. That 7 grand can then be invested all tax
Mm-hmm.
free, and then the growth you won't be taxed on. Or it can be crazy advanced, long short strategy, section 121, section 179, buy a G Wagon. You can be as crazy as that, but do some type of planning for
Mm-hmm.
26. It's a brand new year. Some of these strategies do take a lot of time to do. So you want to start your planning right now. And then for the tax filing, the biggest part is like your 25 taxes is, going to be due 315 for business entities, 415 personal. The big thing is that if you extend, you don't get a time to extend the payment. You only get time to extend the information. So the payment is still due April 15th. So definitely have your ducks in order right now to get that going. Don't wait last minute.
Perfect. And if anyone is wondering, right, I myself am wondering right now, I need to give Tony a call. How can we reach out to you?
Yeah, the best way is going to be our website, thecpaydude.com. And then from there, you can feel free to, book a call with our team on that side. And then all other social media, Instagram, the CPA Dude there. That's probably our most active platform there. TikTok, same thing too, the CPA Dude. So everything we have is the CPA Dude. But yeah, I'd definitely say, follow us on Instagram. We're always sharing tips every single day on how you can save more money on taxes.